Hello and welcome. Today is Tuesday, July 21st. Today is Apple Day. The all I cool, I everything company reports tonight after the bell. So we thought we'd do a little tidbit on Apple because we know there's a lot of option traders out there that like to do volatility plays as it pertains to stock movement. Often after a stock reports its latest earnings, there's going to be a gyration up or down. Apple is one of those stocks that typically gives us, a large move. So the question is to straddle or not to straddle? Well, Apple's basically trading at $150. So all a straddle is you're simultaneously buying a call and a put. Often it's in a 1-to-1 ratio, buy one call, buy one put. And then you hope the stock moves up or down in a large degree. If we take a look at the deltas, you can see the delta of the put is negative 0.47, the call's 0.53. So basically, it's almost delta neutral from a point of pure stock movement up or down. It's a little bit skewed to the call side, but it's because the call's in the money by about 40 cents. Now, in order for this trade to work, upon August expiration, which is in 31 days, the stock needs to move 685 plus 640. So look at it like this. The stock would have to move about $13. We'll just ballpark it. So a $13 move up or down in a month, right? 31 days. Can this happen? Well, in order to know for sure, we'd have to go back over the stock's history. I like to go back over the last 8 earnings reports, and since there's about 30 days to go, I would give the stock 30 days after reported earnings and see how far it could go up or down. And if it came to 80 or 90% accuracy, and the stock moves more than $14, or in this case, basically 10% of the stock's movement, then maybe this would be a trade I would consider placing. I mean, think about that. The stock's at 150, the trade's costing you 13 bucks. You need a $13 move to break even, which is about 8-9%. 10% move would be $15. In order for you to make some profit here, you might consider, okay, the trade cost me $13, and if I want to try to make 20% on that, that's about $2.60. So now you need $15.60 to come back into your pocket, so to speak, when this trade is over. The combination or one of the individual options, their bid price must equal $15.60. Well, that's 10% move. Can Apple move 10%? That's the question. So due diligence can tell you that. But let's say Apple does have a habit of, let's say 8 out of 80% of the time, it does move, let's say 10%. Well, your trade might break even. But what happens if the company, announces earnings? It could be really good, it could be really bad. Guidance could be great, guidance could be, bad. Who's to know? But what if the stock does not move? What if the stock literally opens flat tomorrow morning? What's going to happen to the price of these options? Well, implied volatility rises as the stock approaches its earnings date because there's a lot of uncertainty as to which direction the stock may trend. If the stock goes nowhere or it only moves a couple dollars, $3-4 up, $3-4 down, in fact, it could even go $6-7 up, $6-7 down. These options right now are purely made up of extrinsic value, which is time and volatility. So if the stock does not move if the stock does not move dramatically up or down and you remove the volatility component, these options could drop 20-30% upon market open tomorrow. So just because the stock does not move does not mean you're actually going to sell these options back for the bid prices and assume that, you're going to lose 20-30 cents on each option. You can assume that you're paying 13 bucks for this trade, you're going to lose 20% right out of the gate tomorrow morning, as a rule of thumb. Now, you could buy September's options because you're buying more time. Implied volatility will affect September a little less on a dollar basis than August. But you know what? Can the stock move by that degree upon September? So what I often like to do is I'll pass on the straddle, and then I'll wait for the stock to have its big movement, and then play the movement after the fact. So maybe what we'll do tomorrow is we'll revisit this trade and see what the options look like. If Apple moves a lot, maybe this trade could turn a profit. So hopefully you found this helpful, comparing the straddle to just simply waiting and doing some due diligence. As always, everything in this presentation is for educational purposes only, is not advice to buy or sell. Feel free to check us out at markettamer.com. Have a great day.